Nathan Sheets, PGIM fixed income chief economist and head of a global macroeconomic research, who is also former U.S. Treasury undersecretary under President Obama. Nathan, if this goes through in some capacity, does it push off the peak growth conversation in the U.S.?
I think that the second and the third quarter of this year are going to be exceptionally strong, and it's driven by the rebound in conditions back toward normal levels. But that's almost by definition a one-off event. And I think what this spending does, coupled with historically stimulative monetary policy from the Federal Reserve, is raise the path of growth through the rest of 2021, beyond the second and third quarter, and then into 2022, as $4 trillion of additional expenditure, if it's all approved, goes through. That's going to provide support for quite some time to come. This is going to be a very strong economy.
Which assets do you buy in response to that? And how many of them have already priced in? I guess the question I'm really asking, Nathan, is what hasn't priced that in?
So I think this environment is going to be one that raises all boats. But if you press me, I think I'd go for the cyclicals, for the rotation trade. I think that we are going to see a lot of recovery in some of those services sectors like airlines, hotels, theaters that have been throttled, and some of that's priced in. But I think that there's still room to run there. But I wouldn't want to be negative technology either. I think that there's going to be some solid spending over the next year on goods, and maybe particularly on technology.
We're having some Christine Lagarde headlines come through right now, so I just want to update you on them here, saying that she's seeing good signs in PMIs and some high-frequency data. In the second half, we'll see a robust economic rebound. Nathan, the narrative right now is that we're going to see the baton pass from U.S. exceptionalism to European catch-up. These headlines from Christine Lagarde sort of reiterate that. Do you see that happening, or does it stay with the U.S. story?
Well, my view is the U.S. exceptionalism, the strong growth, the rapid rebound and expansion is here to stay. But by the same token, I also expect that there will be a nice bounce in Europe, particularly during the second half of the year. You know, Europe has trailed the United States in its vaccination efforts, but I think it is going to catch up, and that's going to allow these same kind of normalization dynamics to take hold. Not as much fiscal, but there's going to be a nice bounce in Europe during the second half of the year. And that may be more the surprise to many investors, is the relative strength of the European economy as the year progresses.
Nathan, I'm not going to ask you whether or not you think all of this is going to be inflationary, because we can go round and round on that. But if it was to be inflationary, how would you position a portfolio to be ready for that inflation?
You know, I think that the inflation that we'll get here is most likely to be coming in line with strong economic growth. And so I would focus on the growth. And I think those sectors that are benefiting from the strong economy and the cyclical rebound are also going to be well positioned in terms of pricing power and their capacity to be able to absorb inflationary surprises. You know, as I say that, there's a little bit of a risk that I'm watching, that maybe it's not so much about aggregate demand, but it's about elevated inflation expectations, and notwithstanding a tapering off in demand, that inflation expectations rise. That would be more painful for the equity market and for the bond market if it's higher inflation without the growth.
He didn't say transitory. That was clever, you guys. You talked about that
You did.
without saying.
You
well,
just
now
said
I said
it, though.
but I did.
You
but I
said
just wanted
it.
to highlight it how well you guys were doing with that. We have a drinking game with transitory. I did twice now. Okay, so Nathan, then my question. This puts, I think, the Fed then in quite a tricky line today. I mean, on the one hand, they have to prepare for this growth that could be coming from DC. They've been calling for fiscal. Now they're really getting it. At the same time, the data is going gangbusters. We are seeing a lot of inflationary signs, yet they still have to be cautious. How do they, in their language, do that?
I think what Jay Powell is going to do is he's going to underscore we are expecting some higher readings on inflation through the second half of this year, but we expect those readings to be, I'll use the word now, transitory or transient, as he says. And as we move into 2022, our expectation is that inflation will be back down toward 2%. So I think you build in to the markets an expectation that we're going to see some higher inflation, but we as the Federal Reserve are prepared to look through it. And I think that's how you kind of thread the needle of being able to absorb the strength without necessarily having everybody mark up their expectations for hiking.
US is spending a lot of money. It's going to issue a lot of debts. My question to you to wrap this conversation up, Nathan, is can we have higher yields in the States and a lower dollar?
Absorbing this massive quantity of debt that will be issued is going to be a first order consideration. You know, we got the $2 trillion for the fiscal stimulus, and we got another $4 trillion. Now there are also some tax increases to the extent they're approved. That's an offset. But I think my expectation is the market absorbs it, and the demand for U.S. Treasuries is nearly infinite. But we're going to put that to the test. And similarly, how do the markets respond as they see U.S. debt ratios move up dramatically? And does that undercut confidence perhaps a bit and weaken the dollar? You know, I don't think we're seeing those effects yet, but we've got to be careful. We've got to be cautious and prudent as we evaluate the effects of these packages.